with our 5-year investment time horizon and having been around this block a number of times, we know they're going to come to a deal. They are not going to deprive government employees of their paychecks, Social Security, so retirees of their paychecks. It'd be politically disastrous as we're heading into this election year, and already the field has heated up so significantly. So they're going to get through this. It's a very short-term phenomenon. It might be a short-term fix. And hopefully they do get serious about this at some point in time, but we don't think now is the time.
Cathie Wood's ARK Invest is probably wishing it didn't sell nearly 1 million shares of Nvidia between early October and this month following the chipmaker's massive year-to-date surge of more than 160%. Nvidia's stock soared as much as 30% on Thursday after the company announced jaw-dropping guidance as it benefits from a wave of demand for its chipsets that support generative AI technology platforms like OpenAI's ChatGPT and Alphabet's Bard. But the active investment manager, who has owned Nvidia on and off since the flagship fund's inception in 2014, missed out on massive gains as it started to pare down its position in Nvidia heading into a 52-week low in mid-October. Since ARK Invest's first sale on October 5, when it held 1.3 million shares of Nvidia across all of its ETFs, the stock has soared 190% and added $620 billion to its market value. By late November, Nvidia owned just over 500,000 shares of the company. Today, ARK Invest holds just 390,000 shares across its suite of next-generation technology ETFs. The stock is not in its flagship Disruptive Innovation Fund. Rough calculations by insiders suggest ARK Invest left more than $200 million in potential profits on the table when it sold down its Nvidia stake at the end of last year. In this video, Cathie Wood throws light on the Nvidia investment and why she doesn't think she made a completely wrong decision in dumping on Nvidia. She mentions her very high hopes for Tesla and why she believes is the best play right now. She also throws light on the U.S. economy and the deflationary state of the economy. As you watch, don't forget to hit the like button, subscribe, and turn on notifications.
Very positive on Nvidia. We have been very positive on Nvidia. We bought it down when it hit nearly $100 in the fourth quarter last year. And then it tripled as some of our other AI-oriented stocks stood still. So, we're looking at, believe it or not, many people do not believe this about us. We're looking at relative valuations of names in the AI space. And we were looking at Nvidia at 25 times sales, which is where it is. And Tesla, which is probably the biggest AI story out there, is at 6 times earnings. UiPath yesterday, not earnings, 6 times sales. UiPath yesterday reported it is a beautiful AI play. It too is at 6 times sales. And as far as Nvidia goes, there are a few reasons we take some pause. It still meets our minimum hurdle rate of return, so 15% at a compound annual rate over 5 years. And so you'll see it in some of our more specialized portfolios.
Yeah.
We're looking for the better values. But the risks to Nvidia would include cyclical. When I hear shortages about GPUs or anything, I begin to think about the cyclicality of a group. Competition. Tesla is coming up with its own chip. Meta Platforms, Google, their own chips for more specialized large language models. And then the tech itself. We're learning from Meta Platforms, the Llama model is able to do with less computing power, but more data.
Yeah.
It's able to deliver better models. So there are puts and takes here, as there always are. People who understood the Nvidia story, we were pounding the table on it on 2014, really till 2021. And many people actually put it into their own portfolios, and they may have held it. We have not gotten much pushback. And the reason is people know that we are on AI, but we're doing it in a little bit of a differentiated way. Nvidia has become a check-the-box stock. That's why the valuation is where it is. But we are looking for those plays that have not only the vision from management team point of view and broad distribution, but also proprietary data and AI expertise. So we're just pivoting to another set of plays that most people have not discovered yet, much like they did not understand that Nvidia was an AI play really until very recently.
ARK previously published a valuation model that prices Tesla at $2,000 per share by 2027, which implies a 1,030% upside from its current price. That valuation model hinges on the robot axis, a topic that Tesla CEO Elon Musk recently discussed in an interview with CNBC. He said that full self-driving FSD technology would ultimately allow Tesla to sell cars for software margins, and that ARK Invest has the best analysis he's seen on the topic. Let's get back into the video as Cathie shares her view on her Tesla holdings and further remark on the deflationary environment.
That we believe Tesla is building. It has more data. Talk about proprietary data. It has more data of real-world driving miles than all of the other auto companies and technology companies like Waymo put together around the world, we would say, except for perhaps China, because we don't know exactly what's going on there. And we do believe that the autonomous taxi platform opportunity is a winner-take-most opportunity. The company that gets a person in an autonomous vehicle from point A to point B as quickly and safely as possible is probably going to get the lion's share of the market. And that company will, in the United States, we believe, be Tesla. And we believe globally that opportunity will scale from zero today to $8 to $10 trillion in revenues by 2030. So you can see why we're so excited by Tesla. It is the furthest advanced from an AI point of view, and it's even becoming a manufacturer of factories using artificial intelligence and becoming more and more and more efficient in manufacturing factories and cars. We think it's the most efficient in the world right now. Our history with China after COVID was we plowed in during COVID because we liked what China was doing from a monetary and fiscal point of view. They were not overdoing it. And then, of course, we entered the period starting in November of 20, where managements were basically banished from their companies, and there was one restriction and regulation after another, and so we've pulled away quite significantly. Common prosperity, it seems, means very low profit margins and services that reach into tier 1, tier 2 cities. So JD Logistics and JD, we have some of that, but we have minimized our exposure until China basically seems more inviting to capital once again. When history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply chain, really supply shocks from COVID and the war in Ukraine. And you will see, so sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting. We got GDI, which is the other side, so gross domestic income, which is the other side of gross domestic product. And they need to equal, but they're at a record gap right now. It's been negative, so in recession territory for the last 2 quarters. And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings report. these economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right. If you look at the digital world, gross domestic product that statistic was devised in the industrial age. We're in the digital age right now.
Yeah.
So we pay more attention to gross domestic income, which tends to be more accurate as we're seeing these inconsistencies.
ARK's ill-timed share sale of Nvidia highlights the difficulties of actively managing a portfolio of disruption-focused investments, because even if you pick the right theme to invest in, there's no guarantee you'll pick the right companies to bet on. In February, Wood said ARK's wave of Nvidia sales was in part because its valuation was very high, and that it was consolidating its portfolio to higher conviction names. Wood is instead counting on UiPath for ARK Invest's exposure to artificial intelligence, which is its second largest position across all of its ETFs. Meanwhile, Tesla remains ARK Invest's top holding, which is also working on artificial intelligence to help enable its self-driving technology. But despite the hype in AI this year, those two stocks have only captured some of the year-to-date gains seen across the space. Shares of UiPath are up just 14% year-to-date, while Tesla stock is up an impressive 50%. In other news, Wood has spoken out about the United States regulatory system hindering the country from being a leader in the Bitcoin movement. In her speech at Fortune's most powerful next-generation conference, Wood highlighted how cryptocurrency's center of gravity is gradually moving out of the United States due to its unfavorable regulatory system. She cited Coinbase's recent move to Bermuda to receive licensing, while also expanding its presence in Singapore as an example of this shift. Wood expressed her disappointment on the U.S. losing ground in the cryptocurrency race, pointing out that it would be nice if the U.S. were leading this movement, but we're losing it, and we're losing it because of our regulatory system, Coinbase reported. Wood also referred to the drastic collapse of FTX last year and emphasized the growing need for a decentralized, transparent, and auditable monetary system. She believes that FTX's failure proved the vulnerability of centralized financial systems, a factor that makes Bitcoin and other cryptocurrencies a more viable alternative. There are so many funds against ARK Invest saying they pulled out too early and they made bad decisions, but the fact remains that it is difficult to manage portfolios of disruption-focused investments. Moreover, Tesla shows great promise. What do you think of a $2,000 per Tesla share by 2027? Let us know your thoughts in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.